The Nasdaq is closed for the weekend, so the last reported closing price for Opendoor Technologies Inc. (OPEN) on Friday, September 26, 2025, was $8.81 per share, reflecting a decline of $0.28 or approximately 3.08% in that single trading session. This final figure on Friday comes after a dramatic, almost dizzying swing in the stock's price action over the last several months. Now, the common expectation for Opendoor right now is that it is simply a highly volatile, highly interest rate sensitive housing tech play, a business model, the iBuyer, that is fundamentally broken when the real estate market stalls. But that is only part of the story, and the reality is far more interesting and nuanced than a simple meme stock or housing derivative label suggests. The crucial insight, the thing most investors are missing as they watch the daily volatility, is that the recent surge from a low of around $0.51 to briefly touch its three-year high near $10.87 was not just retail speculation. It was catalyzed by deeply consequential and arguably positive internal structural shifts, masked immediately by a weak third-quarter guidance forecast, which triggered the Friday pullback. The market is struggling to reconcile the dramatic internal restructuring and leadership changes, which should be long-term positives, with the immediate, undeniable headwinds of a tough housing environment reflected in the downbeat near-term revenue forecast. This tension between internal stabilization and external pressure is what you see playing out in the daily stock price swings and volume bursts, and it is a situation that requires a careful look beyond the surface-level panic or euphoria. When Opendoor reported its Q2 2025 earnings in early August, the surface-level results were mixed but generally viewed positively, a revenue beat at $1.6 billion and a return to positive adjusted EBITDA for the first time in 3 years. That immediately fueled a narrative of a successful operational turnaround. However, the expectations were suddenly derailed by the third-quarter guidance, which projected revenue to fall sharply to between $800 million and $875 million, which was roughly half of what analysts had been expecting. This guidance was the reality check that sent the stock into a tailspin in the immediate after-hours trading, despite the impressive Q2 performance. But here's the unexpected layer. Management concurrently announced a $200 million share buyback program, a move typically seen as a strong vote of confidence in the long-term value of the stock, especially from a company that has been historically cash-burning. The buyback announcement, combined with the subsequent news of a new CEO, Kaz Nagiatin, and the return of co-founders Eric Wu and Keith Rabeau to the board, completely changed the expectation landscape. These corporate governance and leadership moves suggested an aggressive, even desperate, a pivot to a leaner, more disciplined, and possibly capital-light operational model. This internal shift is the reality that has driven the immense volume and subsequent massive price appreciation we've seen since August, far outweighing the negative short-term guidance. The market narrative shifted from Opendoor is a failed iBuyer concept to Opendoor is a high-beta restructuring play with a massive short interest and potential for operational discipline, which has made it a darling of the high-volatility momentum trading crowd. Looking at the recent stock movement, the sheer volume on the day of the last close, which was over 168 million shares, tells you that institutional and retail investors are fighting over the stock's future direction. The institutional activity itself is a mixed signal, revealing this expectation versus reality conflict. Recent 13F filings from the end of Q2 showed major holders like Vanguard and BlackRock decreasing their positions, sometimes significantly, indicating a general skepticism about the stock's place in the current high-interest rate real estate market. Yet, newer, more agile hedge funds and active investment management firms have been increasing their stake, betting on the turnaround story and the short squeeze potential. This dynamic, old guard selling into new money buying, is what generates the kind of extreme volatility that makes Opendoor stock the focus of so many online investment and self-investing platforms, often overshadowing more established names you might find on interactive brokers or through the wealth management services offered by Fidelity. It's an ideal setup for a quick trading strategy, but a minefield for the long-term set-it-and-forget-it individual brokerage account holder. The macro environment provides the crucial context for Opendoor's operational difficulties. The core of Opendoor's business model is iBuying, or instant buying, purchasing homes directly from sellers, usually with cash, performing light repairs, and then quickly reselling them. This works flawlessly in a low-interest rate, rapidly appreciating housing market. The moment interest rates spiked, the cost of capital, the expense of holding millions of dollars worth of housing inventory, skyrocketed, crushing the margins. Furthermore, houses sit on Opendoor's books for longer, increasing holding costs and exposing them to the risk of price depreciation.
In Q2 2025, the company's inventory was down to 4,538 homes from a prior year's count of over 6,300, and home purchases had dramatically collapsed by over 60% year over year. This is not a company expanding, it is a company aggressively shrinking its operations to survive the current economic reality. The management team under the new leadership is correctly pivoting away from the volume at all costs strategy. They're shifting towards an agent-led distribution platform, which is an asset-light model where they use their technology to offer various solutions to agents and their clients, a cash offer, a listing with a guaranteed backup offer, or their cash plus hybrid product. This is a clear move to reduce balance sheet risk and move towards a true technology platform rather than being simply a large-scale real estate speculator. This shift is the most compelling part of the long-term reality for Opendoor and the reason for the recent institutional excitement despite the near-term losses. The new CEO, Kasnagiatan, coming from a highly disciplined, technology-first background, is the symbol of this new strategic reality. His mandate is not just to survive the current housing market, but to fundamentally alter the unit economics of the iBuying concept to make it work in any market. The expectation is that this pivot will quickly lead to sustained profitability. However, the reality is that this transformation is complex, and the company still faces significant near-term challenges. Their third-quarter guidance, which projected a return to a negative adjusted EBITDA in the range of a $21 to $28 million loss, clearly shows that the new operational discipline is a work in progress, and the housing market pressure is relentless. The management's commentary about an unfavorable mix of older, lower-margin homes in their existing inventory further highlights the ongoing pain of unwinding prior less disciplined purchases. For anyone looking at Opendoor stock through the lens of a long-term investment or utilizing a structured tool like Schwab Intelligent Portfolios, this stock's volatility would likely be a red flag. For those comfortable with more risk through individual brokerage accounts or exploring niche investing sites, the volatility is the opportunity. The future outlook for Opendoor is a binary outcome based on the success of this strategic pivot. Scenario 1 exceeds expectations. The new asset-light, agent-partnered model gains rapid traction, allowing the company to generate capital-light revenue streams, while its core iBuying model begins to stabilize in a less inventory-heavy format. If the Federal Reserve signals a clear rate cut path, even a modest one, the cost of capital pressure eases dramatically, and Opendoor's unit economics suddenly become viable. If that happens, and the new management team delivers a Q4 or Q1 earnings report that clearly demonstrates control over margins and a sustainable path to profit, then the stock, even at the current price, would be substantially undervalued relative to the new reality. Scenario 2 falls short of expectations. The housing market remains stagnant or rates creep higher. The pivot to an agent-led platform stalls due to resistance from traditional real estate agents or a lack of compelling technology adoption. The ongoing losses necessitate another round of capital raising or significant operational cuts that damage the core business, and the immense volatility subsides only as the stock price drifts downward. The short-term euphoria gives way to the harsh reality that even a talented new leadership team cannot overcome deep-seated market forces in residential real estate. The ultimate reality here is that Opendoor is not a play on the housing market itself. It's a high-stakes play on corporate transformation during a historical economic shift. It's a compelling narrative, one that attracts the risk on capital we often see swirling around stocks that have been recently shorted heavily, looking for a squeeze. But the institutional money, particularly the slower-moving funds that utilize services like Fidelity Investments, will be looking for tangible proof, multiple quarters of improved margins, reduced inventory days, and positive free cash flow. This is where the tension lies. The market expects a miracle turnaround now. The reality is that the turnaround, if it comes, will take time and be riddled with volatile setbacks. It is impossible to talk about the recent price movement without acknowledging the meme stock energy, but the smart money is tracking the operational data. What percentage of their revenue is now capital light? How fast are they selling their existing inventory? And what are their debt covenants looking like in this higher rate environment? Comment below how many shares of Opendoor Technologies you currently hold, or if you prefer a more stable real estate investment like a diversified REIT ETF. The answer will tell you immediately which camp you fall into, the high-risk, high-reward turnaround play, or the more measured strategic investment approach often found with services like SoFi Invest. For Opendoor to maintain the gains it has seen, the reality of its future operational execution must align with and eventually exceed the intense expectations driven by the recent leadership shakeup and short squeeze potential. The recent 3% drop on Friday is just the market recalibrating after a massive run, a constant reminder that the path to operational stability is as but anything but a straight line. the stock will continue to swing wildly until the new management's strategic vision delivers quantifiable, sustainable profitability, turning a narrative of potential into a reality of performance. Investors who are focused on online investment strategies must be prepared for this continued extreme volatility. The short interest remains high, the corporate restructure is aggressive, and the macro environment is unforgiving. All the components for an explosive but highly unpredictable investment proposition. The story of Opendoor is a testament to the fact that even in a traditional sector like real estate, technology can create a highly volatile stock market-driven drama. We are watching a company fight for its model's existence, and the stock price movements reflect that desperate, high-stakes battle. It is a long way from the stability of a diversified Fidelity mutual funds holding. The sheer scale of the turnaround needed means the current price action is less about intrinsic value and more about market perception of successful execution on an ambitious yet necessary strategic shift. We must see concrete proof of margin expansion and inventory discipline to truly justify the massive run-up from the mid-year lows.